presentation contains current opinions of Moe Sansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello, everyone, and welcome to the Compak Market Update. I'm Mo Ansari, and I'm going to talk about the markets, what happened last week, what to expect this week. I'm going to talk a little bit about the inflation number. That's going to be big. It comes out tomorrow morning. Expectation is about 8.8%. That's what the number everybody's expecting. I'll talk about that, the Fed, recession, technical analysis, give you my views of where we are on the market, and then we'll take a look ahead for the week ahead. Let's start with the inflation number. It is climbing. It is fresh highs. We hit 8.6% in March, in the May number. Now, the expectation is the June number is going to be somewhere around 8.8 to 8.9. If the number comes out at this number, 8.8 or 8.9, then we're looking at a number that could be quite a bit negative for the market. That's the way I'm looking at it right now. 8.8 or 8.9%, somewhere around there. That could be pretty bearish overall for the market, especially if it goes up from 8.6. Any number below 8.6, I think it will be a wonderful number, and that could take some of the pressure off the Fed. But if you get a hot inflation number tomorrow, that means the Fed will continue to raise rates 3/4 of a point, expected already built into the market by the end of this month. And then we could also see another 75 basis points in September, depending on what happens to the July, August, and numbers that we see. But inflation has to come down, and that is really what is the key to everything right now that is driving just about everything. We have seen commodity prices come down. Corn is down, wheat is down, copper is down, lumber is down, and down big. So we should see some pressure coming off. But there are other areas of the market where we are suggesting. The tips, these are the treasuries that are inflation protected tips. They have come down. So they're expecting inflation to start coming down. But we have not seen that yet. We want to see that before we start making decisions on the portfolios. Again, the biggest number that I always look at, and this is one chart, that when we see inflation cycles historically, what we've saw over the last 50 years or so, in the 70s, when we saw inflation go up, after the inflation peaked, we had a peak in inflation. Inflation topped and started going down. 12 months after that, the market was up 10.8%. 1975, when we saw the inflationary cycle, 12 months later, the market was up 22%. After the inflation peak, market was up 25%, 14%. So the average return, the median, is about 16% after inflation peaks and start going down. Tomorrow, it is expected to be even higher than where it is today. So if we get a number higher than 8.6, we haven't seen it. There is the expectation that we are going to see a slowdown in housing. We are going to see a slowdown in spending, but it has not happened. So I would wait to see that happen before I would start to redeploy. The Fed this week, interest rates have pulled back from recent highs, which is a good sign, a little bit to the downside. We saw an inverted yield curve where the 2s are higher than the 10-year. That usually it gives us a recessionary cycle. We're about 8.5 basis points now. The 2 is higher than the 10-year note, and that is usually not a good sign for the market. Treasury yields, if you look at that, they hit the 10 years, what we watch very carefully. They're 2.88. They've just been hovering right around here, about the 2.75 to 3% area. Employment situation, we need to see the employment going back up. Unfortunately, that will show us. Last Friday, we got the employment number that showed that we created 372,000 jobs. And that is a lot of jobs we created, a lot more than the 250,000 that was expected. So that is going to keep the pressure on. Until people start getting nervous about their jobs, people are going to continue to spend. And that is what has propelled this market. The recession, the chances, the average performance 6 months before a recession, for the stock market, average performance after the end of the recession is what we see the market take off. but we don't even know if we're in a recession yet. So you look at the market, it before the recession, it just goes a little bit lower, down, up, down, sideways really in the market when we're going into the recession. And that's where we are right now. And the market has been going sideways. Bonds have not shifted gears yet because people are still worried about the Fed raising interest rates. That is putting upward pressure on interest rates. But when the recession comes, usually the bond market goes up and the rates come down. That has not happened yet. So we'll see past recessions. If you look at them, they've lasted somewhere around how many months? About somewhere around 10 months. That's what we're looking at. If you look at, draw a line right through here, the middle, yes, the 2007 recession, that was a structural recession where we saw the recession get a lot worse. It was one of the worst recessions. I don't think we're headed for that here. There's still a lot of liquidity. I think it's just inflation that we need to get a hold of. See, technical analysis, if you look at that, 10-year yield peaked right here, 5-week fifth wave top. And since then, we've just sort of gone up and down. This is the 50-day average, which is around 3%. We're right at 3% or 2.958 today is where we closed. But it'll depend on where. I still expect long-term rates to head higher. I'm going to talk about these technicals a lot more in today's webinar that I'm going to do. It's going to be an hour and a half where I'll go into a lot more detail. But the market failed today to get above the 20-day moving average. It could not even get to the 50-day. Next support is right around here, which is around 37.50. If we break that, then probably headed to the lows that we made last month. Weekly charts, similar picture. We need to get above this downtrend line that we've seen that connects this high, and we come down, and that's where we're sitting right now. A 50% retracement of this entire move from here, that was the bottom in March of 2020 or April of 2020 to the high that we made this year, would put 50% would put us somewhere around 3,500 plus or minus for the S&P. And that does seem like somewhere around 3670 to 3550 becomes a target. We closed at 3818 today. So still, I think the pressure, the trend is to the downside. Same thing, the Nasdaq came up to the 50-day moving average, failed to get above the 50-day, has turned back down, broke below the 20-day. A little bit of support right here, and the major support is last month's low, which is 10,565. If we break this, especially on the weekly charts, we've come and tested these 4 times. This is a 200-week moving average. We've come and held it 1, 2, 3, 4 weeks in a row. We break this 10,864, 10,864 or so, then the really support comes down to about here, which is around 10,800 plus or minus. And real support is right along here, which is a lot lower than we are right now. That puts us around somewhere around 9,000, I would say, is the number that I would look for. But again, the markets are still in a state of flux. We are seeing still a lot of volatility. I'll talk about my dot plot today and in the webinar in a lot more detail. When the market is above it, we're in a bullish trend. When the market is below the dots, it is in a bearish trend. The dots turned negative at the beginning of this year. They turned positive last year in April of 2020 and stayed bullish all the way up till about a couple of weeks. So the dot plot is still negative, and I'll talk about that in detail. Crude oil had a big down day today. I think the market is starting to look for a recession, and as that happens, demand is going to fall off, and that demand is going to really bring prices down. Support is at the 200-day, which is 92.32, resistance at 110. Gold market does not look good, even though inflation should be a positive for the gold market. We have not seen that. We've seen the market sort of just drift down in the weight of a higher dollar. As the interest rates go up in the United States, so does the dollar. And when the dollar goes up, that is negative for gold. We're sitting right here at this resistance right here, which is around 17 support, 1725. If we break it, we went intraday down to here, which is around 1675 would be the next support on gold. Those are my views. That's the way I'm looking at the markets. Again, I still think we're going to drift into a recession or a slowdown going into the end of this year, but the market will bottom before the GDP and the economy will continue to go down. Interest rates will continue to go up, but the market will take off and everybody will say, why did the market go up? Wait a minute, we're in a recession. It's as we go into the recession, the market goes down. As inflation peaks, the market anticipates and looks forward to what is going to happen 6 months from now, not at what is happening now. Markets started to go down at the beginning of this year in anticipation of higher interest rates and a slowdown. Market is already down approximately 19% or so for the S&P. So we do have some more, I believe, downside pressure over the next couple of months. And then once we see a peak in inflation and a rolling over inflation, that's when we see the market turn around. In the week ahead, I'm looking for the market to basically tomorrow, they get the CPI and then the PPI that we get later on this week. That is the producer price index and the consumer price index. That'll really set the stage. I still think that higher inflation, hotter inflation will be here, but if we get a number less than 8.6, that would be good. So we will see how this plays out. Don't forget to tune into the webinars, which I do every quarter or so, every a couple of months or so. Those are a lot more detailed. You can go to compak.com and get all the information. That's compak.com. Also, if you need help with your portfolios, you can give us a call and we will be more than happy to help you. Absolutely free to get you started, get you pointed in the direction and share with you what we do and how we do it simply by going to compak.com, or you can dial pound 250 on your cell phone and say, talk to Mo. Those are my views. That's what I'm looking at this week. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moez Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.